Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Welcome, everyone. I'm Brian Love, your co-moderator for today and head of banking and Fintech at Travillian. Travillian is a boutique executive recruitment firm serving the financial services space since 1998. And my division specifically covers community banks around the country, and we love assisting these institutions who are the lifebloods of their communities, lending to the small businesses and people who live there. To sustain these very community banks in the future, Travillian partners with them on executive search and succession planning projects, as well as helping them craft internal and external communications and content to their constituents. Please connect with us on social media or at travilliangroup.com to sign up for our mailing list and learn more about us. So joining us today is Alexander Rolfe, Managing Director at JCSmithAdvisors and longtime former FDIC examiner with an expertise in bank failures and bridge banks. As he put it, the doctor and mortician. Alex, welcome to the podcast.
Thank you, Brian. Thank you, Indra. I'm very happy to be here. I love what you're doing. I mean, on a personal level, I think having these dialogues is important right now in the process. It's dialogue. We have biases, we have views. People get offended. People have facts and opinions to share. All of that probably will come out today, and I'm happy to have that happen because it is the process we need to go through as we think about what happened and where we go in the future on this.
Well, much appreciated, Alex. And you're right. There's a lot going on, a lot of hot takes around the Silicon Valley Bank and Signature failures. You and I just started to get to know each other a little earlier this year, and I really enjoy your perspective from the introduction. Being a former FDIC examiner working on bank failures, right. Indra and I wanted to really kind of ask you some provocative questions around this moment that we're in. So my first question to you, Alex, is it seems there was complacency in how risk was viewed at Silicon Valley Bank and Signature Bank and their subsequent failures.
Right.
Risk was seen in terms of compliance with reporting rules. Why did so few bankers fail to see that after 10 years of QE, a rise in interest rates would be inevitable with the non-transitory inflationary backdrop?
Yes, this may be a human psychology topic, but I can tell you my view on this. It's kind of like with big events. Where were you when it happened, right? I would take that back. Your question takes me back to 2021. I can tell you I was advising on a banking project in Central America, right? And we're sitting around the table. You have different bankers, somewhat far removed from the U.S. banking sector. And we see inflation prints in the 5 to 6% range, right? And I'm down there, and in that table, right, we have different folks from different countries saying, wow, think about that. They're talking about Paul Volcker. They're talking about rising interest rates and what's going to come. And that was a couple time zones away in different languages and different countries. And that conversation was going on in 2021, right? So the Fed, doesn't really start to take any action until March of 2022 with the beginning of rate increases and turning off QE and turning the vacuum on. I mean, it's explicit. They said we are starting QT at a certain rate, and we're even going to ramp it up at the end of 2022. They broadcast this, right? And I had been watching, Brian. To their credit, the Bank of England started raising rates back in 2021. Every meeting, and the Fed picks up on this theme in March of 2022. And, to kind of give you my perspective, the Bank of England has rates going back to 1694 on the website, right? You can pull every rate change from 1694. So that, they have a pretty good history in this. And I was joking with someone recently. I said, if you want to impress your interest rate risk examiners right now, tell them you went back and looked at rate conditions when the Crimean War began in what's now Ukraine, and you're using that to think about how you model rate risk today. You say, oh, we've got great data sets. So this is, this is a multi-hundred-year kind of topic that rates change. So my personal view is that, on this question of how did we get there, that this wasn't seen, I think a lot of people took the bait for a long time on the topic of transitory, right? I mean, that was a fierce argument, but everything's transitory, right? Bank failures are transitory. Flooding is transitory. The fact that it goes away at some point in the future doesn't mean it's not a problem today. And I regret that as a country, we spent so much time arguing about inflation as transitory or not, when that really is a canard. I mean, it was inflation. We knew it was inflation. Other central banks knew what inflation was. And that, naturally kind of telegraphs that action should be taken, not that it'll go away in the future. So the logic of transitory is a fun one to play around with, even at your bank. If tell your examiners your asset quality problem's transitory, and not to worry about it. So that's kind of my view. I think it was normalized.
Well, and Alex, I mean, obviously, the rates going up and how that affected investment portfolios, that's kind of the postmortem looking at Silicon Valley Bank that caused their failure, right? And so,
right.
What I wanted to now, thinking about the ramp up to it, let's think about where we are now and going forward. Okay. The headwinds and after effects of this earthquake, right? Of these failures. Have you seen notable tightening of credit to preserve liquidity? And also, any signs of cost of credit going up and availability of credit going down?
So yeah, let me start maybe with the headwinds. I think regulatory uncertainty is a headwind. Policy uncertainty is a headwind. I would and do advocate that, policymakers, let's diagnose the problem, what happened, conduct the autopsy here before we start getting into the needed changes, because you're already seeing within days, policymakers and politicians have answers where a lot of experts are still saying, look, let's stay back on this and watch what happened. I have strong views about what I suspect happened, but on day one of this with SVB and then Signature, I said, I'm happy to look. There's a lot of things I don't know. I don't know what the examiners saw and said and were overruled, and let's get all of that out. We have the time to do that. Yes, I think the cost of credit's going up, and it should, because it reflects the cost of capital going up. Good CFOs know, and especially if your bank pays it, your bank shareholders pay attention, you want returns in excess of your cost of capital, not just a 1% ROA. You want to provide value for the capital you've been entrusted to invest, and that you better get returns above what it costs that capital, the cost of that capital. So look, I haven't gone as deep on the availability of credit in the data, but logically it seems right. There will be regulatory and risk within every bank to prioritize liquidity right now over credit availability. So I think logically it should tighten. I'll probably need to see the data, but it seems like that's what's coming.
Appreciate that. I'll turn it over to Indra for another question. By the way, your introduction as the mortician and then talking about autopsies, it just kind of like, kind of adds a little more credibility to that. But that's what we need to do. We got to pick up the pieces and figure out this story, right?
Right.
Go ahead, Indra. Next question there.
Yeah, thanks, Brian. Alex, the U.S. banking industry is generally well capitalized with ample liquidity with a record level of profitability. Are we out of the woods yet of a potential contagion? Is there stress building in the banking system?
It's a really good question. I would key in probably on the word generally, right? I mean, this is the old joke about someone with, their feet in the freezer and their head in the oven, and on average, they're pretty comfortable. We have 4,000 plus banks in the US. So I think you're correct, generally well capitalized, generally ample liquidity, but the beauty of our system, I know the numbers have been falling from, we had close to 20,000 institutions, and now we're trickling down to 4,000. But when you compare that to most countries, this is, fantastic to have that sort of, diversity of geography and bank types and business model types. I think risk is actually leaving the system in an appropriate way. I mean, each of the banks that you guys represent are taking actions to make sure they're going to be resilient and serve the communities they're in. And if you look at the history of the current only 4,200 banks left, 2,000 of them were chartered between 1900 and 1950. So you've got a number, thousands of banks that are a century plus old. And I'm not even talking about the ones that were chartered before 1900, which is another huge swath. So those banks know they have to be resilient for the long term, and that they're taking those actions. But the thing that, and I know we can probably get into it later, but this discrepancy around interest rate risk, unrealized losses on securities, and accounting capital versus regulatory capital, that's not been resolved yet. I think I don't know if that stress is building, but it's got to be resolved.
My next question is the $20 billion loss to FDIC fund from the First Citizens acquisition of Silicon Valley Bank. Could you explain the mechanism, and how do you see this hit to banks in general?
Happy to. This is an area that's pretty technical. And so I'm always happy to explain what's going on in these resolutions and how it flows. But the deposit insurance fund is the tangible, risk absorbing pool of capital that the FDIC maintains to absorb losses in bank failures. And I want to define what losses mean. In this case, what you're talking about, Indra, is losses. It's the cost of providing coverage to the insured deposits, and that is basically what exceeds the liquidation value of the assets that the FDIC now is administering in the receivership. So in this case, insured deposits at first meant 250,000 roughly, and it's pretty complicated, the systems around that. But on Sunday of that failure became all deposits, right? So FDIC absorbed a lot of loss in order to make all of those depositors whole, in excess of what they think the value of the assets that the FDIC can take time to liquidate will provide. So that's how that's estimate comes about. It will change. It will change. It's an estimate at a point in time a few weeks ago, but over the liquidation of this receivership, the markets and the FDIC will see what the real cost of SVB is explicitly on the fund. I'm a fan of the structure. I mean, I'm probably biased because I was a former FDIC person, but I do like the concept of losses being borne by the industry rather than that direct tie to waiting on Congress for appropriations and everyone has their say. And I think this part works pretty well. I mean, because this systemic risk exception was used, there's a special assessment program, which I believe the FDIC and Chair Gruenberg have great authority in how they administer that cost back to the industry. And so I believe that means I think that's a nice way of saying they'll push the cost to the largest banks and try to keep it out of the realm of the smaller banks. Could be wrong on that, how that plays out. So that's how that works.
Kind of on that topic, a little bit of a different, kind of tangent here. Over the last 3 weeks, my constituents, the CEOs I talked to in the sub 10 billion space, sub 20 billion space, there's a lot of fear about deposits leaving the community banks and going to these too big to fail banks. And I was sent a clip about a week and a half ago. Senator James Lankford from Oklahoma challenged Janet Yellen in a video. He's a little bit of a hero, folk hero to these CEOs, because he was challenging her on what Washington is doing about keeping large depositors from moving to these banks that are perceivably, where you can keep all your money without having any real, worry about it.
Right.
Her comments are troubling to me and troubling to these CEOs because there's really not been a lot of clarity around how community banks play into this. Any thoughts on this topic?
Yes. This won't be very assuaging to fears, right, of the CEOs on the call. We've seen the flows happen. It's logical, right? It's not necessarily these people's fault, these corporate treasurers. They have their own duty, but it is happening. I don't think that's a point of argument. What I would say, though, that, I think back on the long track of history is that fears like this subside over time. I think corporate treasurers will end up pulled back to the smaller institutions that are nimble, innovative, more effective at customer relationships. But that's not really an answer either, right? That look, people will forget about this, they'll move on. I do think it will happen, though, that you'll start to see those relationships get filtered back out of the GSIB too big to fail banks and back into competitive, well-run regional and smaller banks. I think, let me give you one more bit of context on this. This problem never went away. It didn't just creep up earlier this month. It's been here at least for 40 years. And I thought I would just read a two sentences from 1991 from a congressional hearing. And I could, this could be 2023, in fact, but here it is. The decision to protect all deposits of the three Bank of New England banks again focused attention on the too big to fail bank disposition policy. During congressional hearings, January 9th, 1991, members of the House Banking Committee had expressed the views that paying depositors of large institutions in full was not only unfair to those with deposits in small banks, but also undermined depositor discipline, right? So let's remember that's 1991, and that's a repeat of arguments from the 80s around things that were going on with this. So, I don't know that Yellen has a cure for it. I don't even know if she was focused on it until March, right? But this is a public policy debate, and I think each bank in the ring, from small to large, needs to get engaged on this. Or we'll come back and do it again. We can have this, the three of us can jump on this call again in 15 years and talk about it again,
Well, what I'm hearing is, I think the federal government puts their money on people forgetting. I mean, just like memory levels being shorter. And by the way, with the advent of social media and smartphones, it probably is short attention span theater, even more so than 1991 or 1980. But that's not a strategy, by the way. That's just like, let's just hope they forget.
Yeah, exactly. So look, on this, if this is a strategic imperative, right, in Congress and in the public and in banking, I mean, there's been rumblings for decades around the largest banks, right? You have, should they be broken up, a la antitrust sort of thinking of the early 1900s? Are there, you would think, right? Shareholders would at some point say, certain of these very largest banks don't seem to return profits in excess of the cost of capital we give them. Why do we keep investing in them? But that hasn't really happened either. So there's, I think it's a great debate to have before we get distracted by something else. That the industry, everyone has deep feelings on this. I don't have the answer here, but I'm just highlighting that the problem, we keep coming back to this problem.
On the talent side, which is our bailiwick at Travillian, what is your anticipation of how different skill sets might be born out of this, that banks will need to potentially hire or acquire those types of skill sets? What is your thought there?
So I think I have a like metaphysical type of question, then I just have like a bare bones, right? I think you need someone who has a very long-term perspective into the past and into the future that thinks about cycles, right? And that's a CFO as well. And that's not an age thing, right? You have young people who like to learn and think about the future, and you have older people who don't remember the past that they went through, and they, so it's not an age question. I think it's a mindset of people who see very long cycles and can put their situation in context. People who speak up could be of great value. Thinking about voicing opinions that are unpopular in the boardroom. I think that's great. And I think boards should be open to say, please challenge us and challenge each other. So I think that's right. I suspect this focus on liquidity and interest rate risk will put some real pressure on even smaller banks to have someone who's good with data and can quantify why their bank's deposit base is stronger than their third-party interest rate risk modeler might show. I think that would be a good skill to have.
Well, thank you. I mean, those are very interesting points. I agree. Data, everything. Banks need data. They've needed it for 20 years, data folk, but this just intensifies it. Understanding, you're right. In the case of a deposit run, deposit pricing, all of those things, we need to get even more and deeper into those metrics. For our clients, especially where the future business is going to come from, and all of that. It's great responses on that, and also folks that are outspoken, that are not just sheep, so to speak. I like that response. That's not a skill set. That's more of a cultural type of human, right? And I just like that you mentioned that. Well, then let me go to my next question, and this actually references an article we read that you were quoted in the Wall Street Journal. It was an article entitled, "We Never Thought a Bank So Successful Could Collapse So Fast." So
that's not my quote, but I know what you're saying. That's the article title.
The article was titled that. Your direct quote was, "SVB was one of the banks that obviously gave us concern." This is when, you were, I guess this was referencing your concerns back when you were at the FDIC, perhaps?
Right. Yes, in a large and complex bank resolution group.
So, okay, appreciate that. And, I just want to make sure we get it exactly right and attribute it to you correctly. Why and how did SVB fall off the radar, do you think, of regulators, FDIC and Fed? And, maybe then you could even take us through some of that resolution plan as well.
Yes, that SVB was a topic of interest, and I credit the Wall Street Journal for highlighting back in 2015. It grew from 7 billion to 50 billion, but in like 8 years, right? Yeah. So it was arguably a large community bank, in the asset sense. It obviously much bigger than that, even at 7 billion. But it grew to 50. And then from a resolution perspective, and a lot of people don't understand this distinction, a lot of the things you're concerned about for risk of an open bank are different in resolution. And so on the risk side, you may not care if some of the critical functionality of a bank falls into the holding company, or in this case, does a lot of the value that's created by the bank get stored in the holding company. That was a little bit of a concern because in failure, the FDIC is in charge of the bank and the holding company continues on. It's cleaved at failure. So in the GSIB banks, this is very common discussions around resolution planning. Can the bank function in a bridge bank? If the bank has failed, what value should be in the bank that's now stuck in a holding company that's not part of the receivership? So that raised a lot of concerns at the time, and rapid growth. Now on the resolution planning, I mean, this bank didn't file a resolution plan until December of 2022, so a few months ago. Anyone who's done a lot of work in that space looking at these knows that the common refrain is, if we fail, it won't be a problem because the FDIC can simply sell us to another bank in a whole bank M&A transaction. And sometimes, right, that happens. Sometimes it doesn't. So it's not, it's kind of a starting point for resolution planning. That's the preferred outcome. It's the least disruptive to your operations today to assume that. So the timing of this bank, that process was really just beginning for SVB of thinking about, formally thinking about it. But just to be clear, the FDIC has always had a mandate to be able to resolve any bank in the US. It doesn't matter if it files a resolution plan or not. Obviously, that's easier said than done when you think about the size and complexity of some banks. But that mandate's always been there. One thing I think about, when you think about how we got to this point, I do look forward to seeing the exam reports on SVB. And we haven't really talked on Signature, but on SVB, I really do want to see those. And to our prior discussion, right, that disagreement's okay, and you can be public about it. I think back to my examiner days. There were times where more senior people had a different view on a risk at a bank. And I said, that's fine. I disagree. And in the confidential section of the report that the bank doesn't see, I want it noted that I do not agree. Here's my view. And that's fine. And I'll be curious to see if the examiners called it right, or if they called it right and were overruled, and even did they agree or disagree with that approach. It'll all be really fascinating to see. But I think that skill, and to the point of just raising your hand when you think there's an issue, is totally fine, even for the examiners to do. And because your name's on the report, right? Someone has to have their name on it. And it's okay to have disagreement within the regulators behind the scenes. That happens a lot. The banks don't see it because they don't see that back and forth. They see kind of a singular communication. So I would just urge examiners and banks right now, right? It's okay to have a varying viewpoint from what more senior folks say and document the difference. And that's okay. The Supreme Court does it. We don't look for them to all agree.
So Alex, that's about all the time we have. Thank you so much for joining us today. Your perspective, your prior experience really, gives you a unique outlook on the past, the present, and the future. We greatly appreciate you joining Travillian Next today, and appreciate your time.
Yes. No, thank you, Brian. Thank you, Indra. Really enjoyed it. Looking forward to doing it again.
Thank you, Alex. Appreciate it.
All right. Thank you all.
Thanks so much.